So guys, for this week, we are just going to draw on where we took off last week. We're going to spend this week focusing on analyzing transactions. So last week we learned a lot. What are some things we learned? Anybody? Yes. The balance sheet. We learned an income statement is revenues and expenses. But remember, there was one thing I told you that was the most important? Yeah. The accounting equation. Assets equal liabilities plus stockholders' equity, which is ultimately the balance sheet. So we're just going to delve into this a little more. Please stop me if you have a question. And if I don't see you raise your hand, you can speak out. That's okay with me. So we are basically going to spend this time really looking at various types of transactions and figuring them out. We are going to use what we call this accounting system to show increases and decreases in the accounting equation. And we're going to learn about various accounts. Now, we already kind of did last week when we started talking about cash, when we started talking about supplies, equipment, accounts payable. All of those are accounts. In its simplest manner, accounts have a title, and there's a space for recording increases in an account and a space for recording decreases in an account. Know that when we look at, I think this was last week, we were going through some transactions of net solutions, and we learned of 3 asset accounts last week. We learned of cash, supplies, and land. Then we talked about liabilities, and those are claims that other people have on the resources. We owe people money. There was an accounts payable, so we possibly received some supplies, but we didn't pay for them right away, so we owed that money. Then we started talking about what was called owner's equity. I don't want that slide to show that way. I'm sorry, guys. Then we had a slide called owner's equity, and the owner's equity, what were the claims that the owner has to those resources. And drawings, owner's drawings, we talked about, those were monies that the owner was taking out of the company. Then we expanded this owner's equity section to talk about revenues help increase owner's equity, expenses decrease owner's equity. Do you remember that? So that's where we got to. And what we learned is those accounts, we did learn some of those accounts last week. We learned that cash is a resource, supplies is a resource, land is a resource, accounts payable is a liability. And guys, apart from one account, any liability will have the word payable after it, except one, which we'll learn about. But you'll know it's a liability because it has payable after it. It will always have payable. Another thing, revenues usually have the word earned or revenue after it, or sales or revenues. And you'll know it's an expense because what's it going to have after it? Expense. Except prepaids, which we'll talk about in a minute. Okay? So we are going to use what we call a T account. This is a simple way for us to understand various accounts. What we do with T accounts is, depending on what type of account it is, we will debit it or we will credit it. Now, debit means left. Credit means right. That's all it means. Debit is left, credit is right. And you're going to hear me do that a lot. I'll get up and I'll go, guys, what's debit? Left. What's credit? Right. What's debit? Left. Right. Okay, just remember that. Sometimes debit means increase. Sometimes credit means decrease, or vice versa. But for your purpose, and you're going to see this on the quiz, what is debit? What's a credit? Okay? Now, there are times debits increase, and there are times debits could decrease, just depending on what kind of account it is. Here, in this particular cash account, you see that the debit is on the left side, the credit is on the right side, and in this instance, cash, when we debit it, we're increasing it. When we're crediting it, we're decreasing cash, and cash will always have a normal debit balance. So in this example, you see there was a transaction for A, that $25,000 went into cash. There was a transaction for B where we used up $20,000. There was a transaction for D where we received $7,500. A transaction on E where we used $3,650 in cash. The transaction F, we used up $950 in cash. And in H, we used up $2,000 in cash. So if we total the debit side and we total the credit side, we end up with a debit balance of $5,900. Does that make sense? This account is just a way to illustrate the effects of transactions on the account and ultimately financial statements. Now, we're going to learn about recording transactions in accounts. Increases in assets are always recorded on the left side of the account, which we call the debit side. Decreases in assets are recorded on the right side of the account, which always is called the credit side. The excess of the debits of an asset account over the credits is the balance of the account. An asset should always have a normal debit balance. Does that make sense? Now, another thing I just want to show you, I guess I could, well, I'm just going to show it to you this way. Assets equal liabilities plus owner's equity. What side of this equation is assets on? Left. What is that? Debit. So do you see assets are going to have a normal debit balance because it's on the left side. And liabilities and owner's equity is on what side of the equation? Right. And so they are going to have a normal credit balance on their accounts. Yes?
What do you mean by normal? You keep saying that it has a normal balance.
Okay.
Is that like positive balance?
No. Debit means what?
Left.
Left. So the normal balance of an asset will always be on the left side.
What do you mean by normal? You keep saying normal balance.
Okay.
Normal, what does that specifically mean?
Good question. So we hope in our bank account, thank you for asking, because I can, say some stupid things. In our bank account, don't we want to have plus more than zero?
Yeah.
Do we want to have minus 500?
No.
No. What is normal for cash? Over zero. Okay? A minus 500 would not be a debit. A minus 500 would be a credit. And we really don't want, although it can happen, we normally want a debit balance in our checking account. Does that make sense? Land. When we purchase land for $20,000, if land's an asset and we show we've increased our land by $20,000, are we going to debit land? We're going to debit it because it's an asset and it's on the left-hand side. You can't have minus 20,000 in land, can you? Do you see why that's a normal debit balance? Does that make sense?
Thank you.
Sure. On the other hand, owner's equity. When Joe puts 20,000 into his business, what happens to that 20,000? What's one account that's affected? Cash increases 20,000. So since cash is on the asset side, we debit it cash, 20,000. What's another account that's being affected? Capital. Owner's equity increases 20,000. But what side of the equation is it on? Right. And so that would be a normal credit balance. Do you see? When we put 20,000 into a checking account or 25,000 from the owner, cash increases 25,000, owner's equity goes up 25,000. Since owner's equity is on the credit side, that's a normal balance of credit. Does that make sense? Kind of. Hang in there with me. So, the balance of the cash account of $5,900 would be the excess of the debits over the credits. If the debits are $32,500 and the credits are $26,600, the balance is going to be $5,900, shown here. Does that make sense? Okay. Now, a group of accounts for a business is called a ledger. And a list of the accounts is called a chart of accounts. Let me explain it this way. For a CPA practice, I don't have manufacturing. I don't have products. I don't have inventory. So in my company, I have specific accounts for my company. Does that make sense? Where for the school, they're going to have different accounts. They're going to have grants. They're going to have tuition earned, received. I don't have tuition. I just have income tax income tax revenues. Does that make sense? We all have different types of accounts for a business. And that list of accounts used for a specific entity is called their chart of accounts. In my business, I don't have any land or I don't have a building. Does that make sense? So I don't need those accounts because I don't have that. In my business, I have rent expense. Some businesses who own their buildings wouldn't have rent expense. So each company's unique with what types of accounts they need for their transactions. The accounts are normally listed in the order in which they appear in the financial statements. So we will notice that, well, we'll talk about that in a minute when it makes sense to you. The balance sheet accounts are also listed in the order they're presented in the balance sheet. And then we have the income statement accounts. Assets are on the right side of the equation. We know assets are resources. Another way to say it as assets are the rights of a business entity to economic benefits. Liabilities are other individuals' claims to those resources. or another way we could say it is obligations by a business entity to transfer assets to third parties. What the heck does that mean? Well, it means if we purchase supplies but we didn't pay the bill yet, we have an accounts payable. We have an obligation to pay that supplier for those supplies he gave us. And what do we use to pay? Money. Cash is an asset, isn't it? So do you see we have to transfer an asset to someone who is due that money? Make sense? Owner's equity is the owner's right to the assets of the business after all liabilities have been paid. A drawing account represents the amount of withdrawals by an owner. Revenues are increases in assets and owner's equity as a result of selling services or products to customers. And expenses result from either using up assets or consuming services in the process of generating revenues. Revenues ultimately increase owner's equity, and expenses decrease owner's equity. So for this company we're going to follow called Net Solutions, here is their chart of accounts. Net Solutions uses cash as an asset. They have an account called accounts receivable as an asset. Do we remember what accounts receivable it is? It's when we are due money from a customer. We provided a service or provided a good that we earned, but they haven't given us the cash yet, but we're expecting the cash. So that's an accounts receivable. Supplies are supplies we've purchased we haven't yet used up. Prepaid insurance. Prepaid insurance is when we pay insurance up front for the whole year. Okay? Prepaid rent is another. If we prepay rent for an entire year, we have a resource we get to use for the whole year. Land is an asset. Office equipment would be an asset. For Net Solutions, they have two liabilities. One is a payable called accounts payable. One is called unearned rent. And remember I told you there will be one liability that doesn't have the word payable after it? Here it is. What this means, the word unearned means we haven't earned it yet. So in this case, Net Solution must have a building that it leases. And in this case, whoever is leasing the building gave them a year's worth of rent up front. But that rent, until the month goes by, that because of time the rent gets used, isn't earned. Due to the passage of time, rent is earned. Does that make sense, what I'm trying to tell you? So that other liability that doesn't have the word payable is called unearned rent, unearned revenue. The owner's equity section, we see Chris Clark Capital. That's money that he's put in the business. And Chris Clark Drawing is the money he's taken out of the business. Then we have the income statement accounts. The income statement only shows revenues and expenses. Revenues will have the word earned after it or revenue or services. The expense account will always have the word what? Always. That's how you know it's an expense. Revenues and expenses only go on the income statement. They don't go on the balance sheet. They go on the income statement. So this is the chart of accounts for Net Solutions. This is what meets the needs of Net Solutions. These accounts are numbered for use as references. And we normally use a numbering system to just record each account. So guys, which of the following would be considered an asset in the company's chart of accounts? Equipment? Why not accounts payable? So it's a liability. What about travel expense?
Credit.
It's an expense. What about revenue? It's revenue. So you're exactly right. Factory equipment is a resource. It's the right of a business entity to an economic benefit. So guys, I'm going to intermix all these various exercises in this lecture, and I got so many we might not be able to do them all, but I really think it helps you understand. The following accounts appeared in a recent financial statement of Delta Airlines. Identify each account as either a balance sheet account or an income statement account. For each balance sheet account, identify it as an asset, a liability, or a stockholder's equity. And for each income statement account, identify it as a revenue or expense. Guys, I'm going to give you a real simple understanding. Assets equal liabilities plus owner's equity. That's the balance sheet. Revenue, an income statement account are revenues and expenses. Okay? So like a dummy in this one, I forgot the top one here, accounts payable. I don't know why. Let's just start with accounts payable. What is accounts payable? Liability, and it goes on the balance sheet, right? Advance payments for equipment. Basically, advance payments for equipment. Sorry, this is an airline, so I'm not real always familiar, but basically they put money down on airplanes. So in that case, it's an asset, okay? Because there's a future resource. What about air traffic liability? Passenger ticket sales for future flights.
Balance sheet.
Balance sheet, it's a liability, isn't it?
Yeah.
Now, what does this mean, guys? So I'm leaving to go to Nevada tomorrow night, but I bought my tickets a month ago. I'm on Sun Country. I purchased my tickets on Sun Country. They show, think about it, in their books, debit cash for $500, credit a revenue liability account, unearned revenue. Until I take off tomorrow night, it's not revenue. To them, it's a liability. They're holding my money, but they haven't earned it yet. Does that make sense? So then once I take off at 3 p.m, it is no longer a liability, it's a revenue to them. They are provided a service. But until they provide that service and they're holding my money, it's a liability. Does that make sense? Okay, air traffic liability. What about aircraft fuel? Expense. What about aircraft maintenance? Aircraft rent. Cargo revenue. Cash. Contract carrier arrangements expense. Okay, now I forgot to put in flight equipment, but flight equipment is asset. Sorry, I didn't have that in there. Frequent flyer obligations. Okay, how many of you guys ever fly? So if I go and I fly 500 miles or 1,000 miles, I get a amount that builds up so I can get free tickets down the road. Do you know what I'm talking about? And so basically they're going to owe me something, a free flight eventually. Do you see how frequent flyer obligations will be a liability for the company until that customer uses it? Okay. So just so you understand, that's why that's a liability. Fuel inventory. Okay. The asset because it's an inventory. Got it? Landing fees. Expense. Parts and supplies inventory. Passenger commissions. Passenger revenue. prepaid expenses. This is a trick. Asset. They've prepaid supplies or prepaid rent or whatever up front. Asset. Great. Taxes payable. Liability. Does this kind of make sense to you guys? Okay, next. All businesses use what is called the double entry accounting system. Basically, every business transaction is going to be recorded in at least 2 accounts. Could be more, but it's going to be at least 2 accounts. Remember when we talked about Joe Blow puts $25,000 into the business? And we go, okay, what's one thing that's happened? What's one account that's been affected? And then we go, well, what's another account? That's the double entry system. Does that make sense? There's always at least 2 accounts that are being affected. Every business transaction is recorded in at least 2 accounts, and the total debits recorded for each transaction must always equal the total credits recorded. We will always balance. Remember last week we had some transactions where assets went up and an asset went down, but we still balanced? Okay? We will always balance. The rules of debits and credits mean our debits will always equal our credits. So, here you see with an asset, a debit is going to show increases in asset accounts. And think about it, assets are on the left-hand side, aren't they? So since assets are on the left-hand side, the normal balance for assets will be a debit. Liabilities and owner's equity are on the right-hand side. So a normal balance for liabilities and owner's equity will always be a credit, which means to increase an asset, we debit it. But to decrease an asset, we're going to credit it. Okay? Now with liabilities and owner's equity, to increase a liability or to increase an owner's equity, we credit it. But to decrease a liability or an owner's equity, we're going to debit it. This is a really helpful sheet to keep, like when you're doing homework or you're doing your quiz, to keep this on the side, just so until it sinks in, you know. For revenue accounts have a normal credit balance. I want you to just think of something. I think I told you last week, oftentimes I'll say, what happens to cash? So when we provided services for a customer and they gave us $5,000 in cash, what happened to cash?
Cash flow.
Up. And what happens? It's a debit because it's an asset, right? So if we have to balance and we earned money, the other account that will be affected is a revenue, right? So doesn't a revenue account have to be credited if cash was debited? Do you see how oftentimes I know what the other account has to do based on what we did with cash? Does that make sense, kind of? Revenue accounts have a normal credit balance, and expense accounts have a normal debit balance. Think of this. We paid $2,000 for rent expense for the month. What happened to our cash? Down. And what happens when an asset goes down? We credit it, don't we? We credit it. Oh, sorry, you don't see that. But cash, we credit when it goes down. So if we credit cash to pay rent expense, what happens to the expense? We debit it. You know how we always have to balance? Our debits have to equal our credits. Owner's drawing. When we pay money back to the owner, that's a normal debit balance. Think about it. When we use cash to pay back the owner, what happens to cash? It goes down. We credit it. As a result, the drawing account's going to be debited. Okay? This is a huge slide for me. Everyone write this down. Think of this. Dealer, D-E-A-L-O-R. DEA is on the left hand of the equation, LOR is on the right hand of the equation. What this means are dividends, expenses, and assets have a normal debit balance. LOR, liabilities, owner's equity, and revenue have a normal credit balance. Does that make sense, guys? I call them dividends, you can call them drawings, the equity drawings. So to help you remember what is the normal balance, drawings or dividends, expenses, and assets will always have a normal debit balance. Liabilities, owner's equity, and revenues will always have a normal credit balance. So here's another slide that just expands it. Think about, ultimately, our balance sheet shows assets equal liabilities plus owner's equity. We know that our revenues increase our owner's equity account and our expenses decrease it along with our drawings. So that's all going to ultimately flow right back into our owner's equity. Okay? Now a journal is where we enter all of these transactions. So here we're going to look at some transactions just to make sense of this, guys. On November 1st, Chris Clark deposited $25,000 in a bank account in the name of Net Solutions. Think about it. Two transactions that were affected, cash went up and the Chris Clark capital went up, didn't it? So do you see down here our cash increased, which means it was debited, and over here our owner's equity increased, which means it was credited? Do you see how our assets still equal our liabilities plus our owner's equity? But to post this or to journalize this transaction, we are going to show how cash is increased. This transaction increases an asset account called cash, and it increases an owner's equity account called Chris Clark Capital. To put it in journal form, we're going to show the date, November 1st. We're always going to record the debit side first. Do you see how we have cash and we show it as a debit? And then do you see how we indent Chris Clark Capital and we show that as a credit? We indent the credits accounts. And then we explain what happened. We wrote invested cash in business. This is basically how we journalize every economic event, by creating a journal entry. And then after that journal entry, we can post. Now the software does it all, but we have to understand what the software is doing. So we're going to kind of do it ourselves this week, okay, in the homework. But do you see, we journalize this entry, and then we're going to post this entry to the various specific accounts. Cash increased or got debited $25,000, and the owner's equity, Chris Clark Capital, was credited $25,000. But we still balance, don't we? Don't our debits equal our credits? Do you see over here what we debited? We also had to credit the same amount. Any questions? Kind of making sense? Next, the transactions recorded in the journal showing the date of the transaction, the title of the account we debit, and then we show the title of the account we credit, and then we show the amounts, and we show a brief description. Now, terminology. When we receive cash for services provided, that means the company is getting cash because we provided a service to them. Does it make sense that cash increases and that a revenue account would increase? And when an asset increases, we debit it. When revenues increase, we credit them. Remember that dealer, D-E-A-L-O-R? I'm going to put that up here. Where did I? D-E-A-L-O-R, okay? Drawings or dividends, expenses, and assets. And L is what?
Liabilities.
O?
Owner's activity.
R?
Revenues.
Okay? Does that make sense, guys? You're going to get tired of me asking that. When another common transaction terminology is provide services on account. What the heck does that mean? Well, we did an oil, what do you call it? What do you call it when you take your car to get your oil changed? We did an oil change. God. We provided a service on account. What does that mean on account? They didn't get our cash yet, right? So what would happen in that? Accounts receivable, which is an asset, increases, and our fees earned increase, don't they? When we receive cash on an account, what that means is that oil change I had done yesterday, I go and I pay the $50 bill today. When they receive my cash, cash goes up and the accounts receivable then goes down. They receive the money. They're not going to get any more from me, right? When we purchased on account, think about purchasing supplies. They get delivered, but we haven't paid the bill yet. The asset goes up. And what else goes up? Liability goes up, doesn't it? When we paid on account, those supplies I received yesterday, I go and pay for them. What happens to cash? It goes down. Doesn't our accounts payable also go down? I don't know them anymore. So one side gets credited, cash gets credited, the liability gets debited, it goes down. When we pay cash, say we have a utility bill. What happens to cash when we use it? Goes down, which means it gets credited. And the expense gets debited, or if we purchased an asset, that asset gets debited, right? Because don't expenses have a normal debit balance? And don't assets have a normal debit balance? Then when the owner invests in the business, our cash or other asset increases and our owner's capital account increases. when the owner withdraws cash, the capital account decreases, or the drawing decreases, and the cash decreases. Does that make sense? Kind of. This is another really good slide to just hold on to and to write. So when you have questions, you can go back and go, okay, what do I do here? Next. Net Solutions paid $20,000 for the purchase of land as a future building site. Do you see here the journal entry will be land is an asset, and that increases. So we always show our debit transactions first. And since we used up cash, we credit cash because cash went down. We used it up. And since cash has a normal debit balance, when we use it, we credit it. Does that make sense? So you see here, our journal entry shows on November 5th, we debit land for $20,000 and we credit cash for $20,000 because we purchased land for a building site. If we post these two transactions, land gets debited, the asset gets credited. But guys, do our assets still equal our liabilities plus our stockholders' equity? They still do. Now, on November 10th, Net Solutions purchased supplies on account for $1,350. On account, what does that mean? We haven't paid it yet. We owe them money. Our supplies gets debited, increased, it's an asset. Our accounts payable is a liability. What's the normal balance of a liability? A credit. So when we've increased our liability, we're going to credit it, aren't we? Do you see over here our asset was debited? We have a liability that was credited. Do we still balance? Do assets equal liabilities plus stockholders' equity or common drawings? Capital? Next, Net Solutions received cash of $7,500 from customers for services provided. We would debit our cash, and do you see why we would credit fees earned? We earned that money. Do you see over here cash is debited and our fees earned are credited? Do we still balance? Net Solutions paid the following expenses: wages of $2,125, rent of $800, utilities of $450, and miscellaneous of $275. So guys, in this instance, there's not just two journal entries here, or two accounts that are being affected. We spent $3,650 in cash. That's a credit. We used it up. Do you see our wages expense, rent expense, utilities expense, and miscellaneous expense? They're all expense accounts with a normal balance of a debit balance, aren't they? So do you see we're going to debit all of those expenses and we credit cash? But do we still balance? Net Solutions paid creditors on account $950. We would debit our liability accounts payable because we're reducing it. A normal balance for a liability would be a credit, but when we reduce the liability, we debit it. And what's happening to cash here? We're using cash to pay the bills. So doesn't cash go down? And when an asset is decreased, we credit it. So do you see here our asset went down, or our asset was credited, our liability was debited. Do we still balance? We still balance. Net Solutions purchased $1,350 of supplies on November 10th. Thus, $800 of the supplies must have been used during November. This transaction is recorded in the journal as an increase to supplies expense and an $800 decrease or credit to supplies. So what happened here is we had purchased supplies previously, but we went and we looked at the end of the period and we saw we don't have the supplies we used to have. We've used up $800 of supplies. So we want to show an increase into the supplies expense account and decrease our asset supplies. So our asset is credited, our supplies expense is debited, but do we still balance? We still balance. Chris Clark withdrew $2,000 from the business for personal use. The drawing account is debited. The cash is credited. Do we still balance? Do you see here, we always show the journal entry. We show the account that is being debited first, and then we indent the credit accounts and put the cash, the credit balances with the indentation, okay? Here's another exercise. The following table summarizes the rules of debits and credits for each of the items A through F. Indicate whether a proper answer is a debit or a credit. When an asset gets increased, what are we going to do with it? We debit it. What is the normal balance of an asset? It's a debit. When a liability is increased, what do? We credit it. What do we do to decrease? Debit it. What is the normal balance of a liability? A credit. For owner's equity, the normal balance for a capital account is a credit. When we decrease the capital account, what do? Debit it. And the normal balance is a credit. For drawing, to increase a drawing account, what are we going to do? Debit it. To decrease it, we'd credit it. And the normal balance is a debit. Revenues. To increase a revenue account, what are we going to do? Credit it. To decrease it, we debit it. But the normal balance is a credit. Do you guys see that the normal balance is what it takes to increase an account? Okay, you'll always know the normal balance because what increases that account is what a normal balance is. And then with expenses, to increase it, we're going to debit it. To decrease it, we credit it, and the normal balance is a debit. How are you doing so far, guys? Good? Gates Labs is owned and operated by ZH Gates. During the month, Gates Lab has a substantial number of transactions affecting each of the following accounts. State for each account whether it is likely to have a debit entry only, credit entries only, or both debit and credit entries. So with accounts payable, why would we use accounts payable? Because we owe money, credit, but then don't we need to pay them back? So won't we both debit and credit in accounts payable? Doesn't that kind of make sense? We'll owe money, but we need to pay it back. So when we owe the money, we credit the liability. When we pay it back, we debit the liability. What about accounts receivable? Why do we use accounts receivable? Because people owe us money. Or another way to say it is we're going to receive money from customers, right? What do we do when a customer is going to give us money? The receivable is debited. It's an asset. But then what do we do when we get the money from them? We credit it because we're not going to receive it anymore. Right? What happens to cash? We do it all, don't we? Debit and credit it. What about fees earned? Mainly just a credit. Insurance expense? Debit. Gates drawing? Debit. Utilities expense? Debit. Is this making sense, guys? You're just learning it and you're doing really well, okay? But just that dealer thing is really helpful because then you know what the normal balances are. And again, I don't know why this works for me, but if I think, okay, what's happening to cash? If you know cash is increasing and that's debited, then the other side's going to be credited, right? Or if we are using cash, cash gets credited, what's going to happen to the other side? Debited. 2.6. These are various accounts, and identify these accounts as an asset, a liability, owner's equity, revenue, or expense. We'll go through these real fast. Accounts payable, liability, right? Payable, liability. Accounts receivable, asset, debit, cash, Lee-like in capital, credit, Lee-like in drawing, debit, fees earned, revenues, land, rent expense, supplies, utility expense. You guys get it. Okay. Now, here are some transactions. Birdie Consulting Services has the following accounts in its ledger. And we've got cash we can use, accounts receivable, supplies, office equipment, accounts payable, BJ Faust Capital, BJ Faust Drawing, fees earned, rent expense, advertising expense, utilities expense, and miscellaneous expense. They want us to journalize these transactions. So January 1st, paid rent for the month, $3,000. Think about it. Tell me one account that's being affected. Cash. What happens to cash? It gets credited. And what's happening to rent expense? Debited. Do you see we always put the debit account first? So we show January 1st, a debit to rent expense, a credit to cash. Is that making sense? Next one, paid advertising expense of $2,500. Does it make sense? We debit advertising expense, we credit cash. Yes? Next, paid cash for supplies. We debit the asset supplies. Supplies increased, we debit the asset. Cash, what happened to cash? Credited. Purchased office equipment on account. Office equipment, debit, $13,900. Accounts payable, credited. What happens to a liability when we increase it? Over there, DEA-LOR, credited. Next, we received cash from customers on account, $14,770. Our cash goes up, our accounts receivable goes down. Both are assets. Next, we paid a creditor on account for $14.75. Do you see our accounts payable goes down and our cash goes down? Paid cash for miscellaneous expenses. Miscellaneous expenses debited, cash is credited, right? Paid utility bill for the month, same thing. Utilities expense debited, cash credited. Fees earned and billed to customers for the month, $37,300. Billed to customers, it didn't say fees earned and received cash. It said fees earned and billed. Do you see our accounts receivable is sitting at $37,300? And our fees earned are $37,300? Paid utility bill for the month, utilities expense, and a credit to cash. And then we paid Faust cash for personal use. That would be a drawing. BJ Faust drawing, $800. Cash is $800. I went through that kind of fast, but is it clicking? Okay. Here's another one. As of January 1st, Shane Gerber Capital had a credit balance in his account of $314,000. During the year, owner withdrawals totaled $10,000, and the business incurred a net loss of $320,000. What would Shane's capital account be at the end of the year? Negative $16,000. Does that make sense? It's not what we want to see, but it is what it is. Okay? Okay. There I am.
So we don't call it just a negative balance. We call it a debit balance.
That is correct.
Yeah.
It is a negative, but it's a debit balance. Correct. Correct. Okay. Assuming that there were no recording errors, will the balance sheet prepared at, what will the balance sheet, where am I? The balance sheet prepared at December 31st will be reported as a debit balance. This one is looking at transactions and trying to decide what happened. Okay? On this one, number one, do you see a $50,000 up in cash as a debit? And then do you see a Ted Jaeger Capital of $50,000 as a credit? What do you think happened there? He invested $50,000 in deposited cash. Do you see the asset increased and the owner's equity increased? What about number two? Do you see number two, supplies show $4,000 and cash is a credit of $4,000? What do you think happened? Bought supplies. One asset went up, one asset went down. Number three, do you see $10,000 is a credit to cash? Where's my other one?
Accounts payable.
Accounts payable. Okay, let me just see because got it. Good. So number three, equipment went up, debited $30,000. We used $10,000 in cash, and we owe $20,000. Do you see? Here are three accounts that are playing out. But do we still balance? Okay. Do our debits still equal our credits? Yes. Our equipment is at 30. Our credit cash is at 10, and a credit of accounts payable at 20, right? Next, number four, we have a debit to operating expenses of $6,175 and a credit to cash for $6,175. Doesn't it look like we paid some expenses here, guys? Right? Make sense? Next, for 5, we have a revenue account that gets credited for $20,500, and it looks like an accounts receivable that was debited for the same amount. What is this about?
Provided a service.
We provided a service on account, didn't we? We didn't get the cash yet, but we're going to. 6, we have a debit of accounts payable $6,000 and a credit of $6,000 cash. What happened there, guys? We paid it, didn't we? We owed it, but it looks like we paid $6,000 on what we owed. Next, 7, we have an increase in cash of $13,100, and we have a credit of accounts receivable of $13,100. What happened here? We received money on account, didn't we? Number 8, we've got, operating expenses of $2,200 as a debit, supplies as a credit of $2,200. What happened here, guys? We used up supplies. Guys, y'all are doing really well. This is week 2, and look what you're already learning. I just want to give yourself a pat. I mean, seriously, this is huge. Excellent. Yes, we used up supplies. Then the last one, number 9, we have a debit to Ted Jaeger for drawing of $1,500, and then we have a credit in cash of $1,500. What happened here? The owner took out some cash. Our drawing is debited. Our asset cash is reduced. Okay, so basically, we did the journal entries. As you know, so I'm just going to skip through this. But we basically did the journal entries as we were talking about the various accounts. Okay? Is that all right that I'm skipping on? Now, we know that the transaction gets put into a journal, and then we eventually take those transactions and we transfer the debits and the credits from the journal entries to the accounts. We call this posting the transactions. Although T accounts are useful for illustrating and recording the posting of transactions, we usually use a 4-column account which has a date, an item, a posting reference, and a debit and credit. So we've shown this before. When Net Solutions paid a premium of $2,400 for an insurance policy for liability, theft, and fire that covers 1 year. So this isn't 1 month, it's for a whole year. We're going to use an account called prepaid insurance. It's an asset. And we're going to credit our cash. That's the journal entry we are creating. We are journalizing. To post that transaction means we go to the prepaid insurance account and show the debit on December 1st for $2,400. We go to the cash and we show the $2,400 as a credit. Does that make sense? Yeah? Next, the debits and credits for each journal entry are posted to the accounts in the order in which they occur in the journal. The debit portion of the journal entry, in this case, got posted to the prepaid account. We put in the date. We put in the amount of $2,400. We put that in the debit side. Then we showed the journal page number entered. So do you see the journal page number? Here, the cash is journal page 11. The prepaid insurance here is journal page 15. Do you see how we're earmarking them? Then we do the same with the account. 15 is entered in the posting reference, and the 2,400 is shown in the debit column of prepaid. Okay, let me just see what I messed up. We put the date in. We put the debit column in. We put the page number in the posting reference. Where is that? Number 2. Why am I not seeing it? Anyway, we're just earmarking to make sure we're flowing the procedure correctly. So here, this 2,400 prepaid insurance, the 2,400 here, gets put in the debit section here. This 2,400 of cash gets placed in the cash account down here. Does that make sense? Next, the advance payment of rent is an asset, just like the advance payment of insurance. However, unlike the insurance premiums, this prepaid rent will expire in 1 month. When an asset is purchased with the expectation that it's going to be used up in a really short period of time, it's normally put as an expense account right away. The reason we would put something into prepaid insurance or prepaid rent is it's going to be used up over a year. So then a 1/12 of it is used up every month. Does that make sense? But if we pay the rent, it's going to be used up in a month. It's an expense. Does that make sense? So in this case, when Net Solutions pays rent in December for $800, we are going to show our journal entry of rent expense, $800. Then we credit our cash for $800. The rent expense account is a 53. The cash account is term number 11. Do you see how when we post them, we go to the rent expense account and show our debit to 800, and we go to our cash account and credit the 800? That is the posting onto the accounts. Am I losing you guys? Next, Net Solutions received an offer from a local retailer to rent the land purchased on November 5th. The retailer plans to use the land as a parking lot for its employees and customers. Net Solutions agreed to rent the land to the retailer for 3 months with the rent payable all in advance. Net Solutions received $360 for 3 months rent beginning December 1st. So between you and me, I would not put $360 as a liability. I might put $36,000, but because we're doing this book, we're going to do it by the book. They're saying that $360 is going to be earned over a 3-month period. So we're debiting, we show a journal entry of debiting cash, and we're crediting unearned rent because we have not yet earned it yet, because we're getting it before the month. You know, we've got 3 months. So after 1 month, we'll earn a third of it. After the second month, we'll earn another third of it. And after the third month, we'll earn another third of it. Is that making sense? Yes.
So as each month passes, you have to put that down.
Exactly. You have to take a third of it. We would debit unearned rent, credit earned rent. Rent earned, okay? Now, this is a little hokey because the numbers are so small, But if we made this number 36,000, it would make more sense. Does that make sense? So each month we create, well, this particular, we show the journal entry of cash and unearned revenue. And then we debit our cash, we credit our liability. Next, Net Solutions purchased office equipment on account from Executive Supply Company for $1,800. Do you see? We debit our office equipment and we credit our accounts payable because we owe the money on account. We post it. Net Solutions paid $180 for a newspaper advertisement. What are we going to do there? Advertising expense or miscellaneous expense, and we credit our cash. Do you see how we're posting it? Net Solutions paid creditors $400. Do you see? We show the accounts payable of $400 and the cash of $400 as a credit, right? Net Solutions paid a receptionist and a part-time assistant $950 for 2 weeks. Do you see we debit our wages expense and we credit cash? Net Solutions received $3,100 from fees earned the first half of December. What are we going to do? Debit our cash, credit our fees earned. Okay. Next, fees earned on account totaled $1,750 for the first half. What does that mean, guys? We did not get paid. We earned it, but we're expecting the money. So we debit our accounts receivable, we credit our fees earned, right? Net Solutions paid $900 to Executive Supply Company of the $1,800 debt owed from the December 4th transaction. What are we doing here, guys? We're paying down a liability. Exactly. Okay? So we use up our cash. We're reducing our accounts payable. Net Solutions received $650 from customers in payment on their accounts. If they paid their accounts, what's going down? Accounts receivable is going down. Cash is going up, that's getting debited. Accounts receivable, which is an asset, is getting decreased because they don't owe us anymore, right? Net Solutions paid $1,450 for supplies. What is happening? Decreasing cash, increase in asset, right? One asset's going up, one asset's going down. Got it? Net Solutions paid the receptionist. Well, we did something like that earlier. Wages expense. When they pay any type of bill, what is it? An expense. Utilities expense, telephone expense, maintenance expense, you name it. We credit our cash. The electric bill, same thing. When we received fees earned of $2,870, we got that cash. What do? Debit cash, credit our fees earned. And then when we provided work and we earned it, but it's on account. That means it's an accounts receivable. We're waiting to receive the money, and credit fees earned. Clark withdraws money. That's a drawing, a credit to cash. After all of these accounts are journalized and posted, do you see here? It shows everything that happened. Do you see our account cash really gets used up a lot? And then our other accounts receivable, our supplies, our prepaid insurance, our land, our office equipment, accounts payable, unearned rent, Clark Capital, Clark Drawing, our revenues, and all of our expenses all get posted to. Now, guys, in the real world, a software does all this. I must admit, I got out of college in '82, and my first job was with the mortgage company, and I had a big book. I'm not kidding. And I had to go and post this shit to each account. Now, back then, I did have an Apple computer, but it had a little floppy disk, so back then I think it was called Quattro, like what we have as Excel today. So at least I could total things, but honestly, we had a big book. What a waste.
I'm sure
But
all the numbers were as clean as 800 and
Yeah.
4,000.
oh yeah. So thank God for software today. But the purpose of this chapter is to help you understand how software works. Does that make sense? Which of the following is the process of transferring debits and credits from journal entries into accounts in a ledger? Posting. Now, I'm going to let this skip because we have so much more to cover, guys. So know that it's giving you an example here. There was a company that purchased $2,250 of supplies on an account. And basically what they want us to do is show how this process occurs. You see, we create the journal entry. We show our supplies were debited, our accounts payables credited, and then you see how we posted it. Do you see there? How we posted that transaction to supplies as a debit. We posted the accounts payable as a credit. Both of them started with beginning balances. So I'm just showing you how the process works. In here, the same thing. We've got some transactions. And what they want us to do is show the journal entries. So when we bill customers for fees earned, we do accounts receivable, fees earned. When we purchase supplies on account, that means supplies, accounts payable. Is that right? When we received cash from customers on account, we debit our cash of $66,275. We credit our accounts receivable. And then when we paid creditors on account, we debit our accounts payable because it's decreasing, and we credit our cash. Then we show, when we post them all, where the different transactions get debited and credited to. Okay? Does that make sense? I'm going to just move on from this. You guys can look at this later, but I want to cover some more stuff, okay? The trial balance. After we journalize all these transactions, after we post them to those various accounts, we then are going to total each account what is called a trial balance. That's, we put our debits in one column and our credits in the appropriate column. A trial balance just takes each account, we start with the name of the company, the trial balance as of a certain date, and we take the balances of the accounts, starting with the balance sheet, then the capital accounts, then the revenues and expenses. And we post, based on net solutions, we show the ending balance of cash as 2,065. Now, where did that come from? See here? That 2,065, the very bottom number? That's what we're taking. Do you see the accounts receivable has a balance, a debit balance of 2,220? Do you see supplies is at 2,000? Do you see what I'm doing? You're going here and you are just showing every balance. You're putting the debits where the debits go and the credits where the credits go. Do you see how your debits will always equal your credits? And doesn't it make sense they're going to? Because if after every transaction our debits equal our credits, isn't it going to balance? Right? If the trial balance does not equal, there's a problem. The error needs to be found and fixed. Now, guys, the reality is in software, if you put your debits and credits in right, there's not going to be you're going to balance. But because we have human capacities, we're going to screw it up, okay? That is why I gave you those solutions to help you. Just because I don't want you getting frustrated with making a mistake, okay? Errors not affecting the trial balance. An error may occur that does not cause the trial balance totals to be unequal. Okay, what that means is the purpose of this is to have our trial balance where our debits equal our credits. There are ways we can still make a mistake and yet we still balance. For example, I paid wages of $13,000 in cash. What if instead of showing wages expense, I showed supplies expense? Did I screw something up? But would I still balance? Do you understand that just because you balance doesn't mean it's perfect? Because we could make mistakes, but the purpose of this is to see the trial balance. Now, when there are errors, we may need to do a correcting entry to fix the errors. Here, let's show you. Assume that on May 5th, a $12,500 purchase of office equipment for cash was incorrectly journalized and posted as a debit to supplies and a credit to cash for $12,500. It's already been journalized and posted, and we discovered this error about a month later. Before making a correcting journal entry, the journal entry that was made in error is compared to the entry that should have been made. You look at the entries and you fix it. Do you see what we should have done is instead of debiting office supplies, we should have debited office equipment? But our cash is correct, isn't it? We just screwed up put in the wrong account. So do you see the correcting entry will be to debit our office equipment and credit our supplies to make it right? Does that make sense? Now, if we look back on this exercise 213, where we had all these various journal entries, we can prepare a trial balance. You start with cash, then you do in order of liquidity, you do all your assets first, then you do your liabilities, your capital, your revenues and expenses. Do you see in the trial balance how it shows assets first? Does that make sense? Then your liabilities, then your capital accounts, then revenues, then expenses. The accounts here of Seaside Furniture are listed in alphabetical order. All accounts have normal balances. The balance of the cash account has been intentionally omitted. They want us to prepare an adjusted trial balance listing the accounts in their normal order. So guys, we would start with cash. Then what's another asset we would put in next? Accounts receivable and supplies and land. Do you see anything else? That's it. Then we'll put in and those are all debit accounts, aren't they? Then we'll put in our liabilities. What do you see for liabilities? Payables, notes payable, accounts payable. And then we will put in our capital accounts. The Hillard capital is a credit balance. The Hillard drawing is a debit balance. Do you see what we're doing? Then you would put in your revenue accounts and your expense accounts, wouldn't you? Now, they didn't give us the cash balance because they wanted us to fill it in. If we put things in the right, either credit or debit, won't they equal? So they didn't give us the cash, but if we put everything else in here correctly, we should be able to get what our cash is of $426,800. Does that make sense? There can be errors on the balance sheet. Now, what they're trying to go at in this scenario is the guy screwed it up, okay? It doesn't balance. One says 273,700 debits. One says credit balances of 668. Okay, guys, I can just look and see some things are wrong. Prepaid insurance is an asset. What's it doing on the credit side? Wouldn't that be a mistake? Or do you see how Kia Eichart Capital, that should be a normal credit balance, shouldn't it? But you see how it's on the debit side? Or do you see this wages expense? What are expenses supposed to be a normal balance of? Wages expense, debit. So basically what they're trying to do, they're giving you some different things that got screwed up and they want you to fix them. So it goes into a little more detail. The debits and credits in the cash account total $77,600 and $62,100 respectively. Well, it looks like what happened here with cash is they put in the 77.6, but they didn't show the credits of 62.1. You see what I'm saying? They're telling you they left out the credits. So shouldn't the new cash account only be 15.5? Because they left out the credits. Or it says here, a billing of $9,000 to a customer on account was not posted to the accounts receivable account. Well, if it was posted to fees earned, do you see why we're not balancing? We need to increase our accounts receivable by $9,000. Do you see here it says $37,750? Wouldn't we add $9,000 to that to make it $46,750? Or it says a payment of $4,500 made to a credit on account was not posted to the accounts payable account. Duh. So shouldn't our accounts payable go down $4,500? Do you see now our accounts payable sitting at $24,600? See, what they're trying to help you see is what would you adjust to fix this? Here, they're saying the balance of the unearned rent account is $5,400. Unearned rent, do you see they show it to be 10.8? Okay, so if we show that to be $5,400 unearned rent, That's going to adjust that account. The correct balance of the equipment account is $190,000. Our equipment account says what? So if we fix that, ultimately we balance. Do you see our debits equal our credits? So you've got a couple of these you can look at. I have another one set up for you. I'm sorry, I just want to get you out on time and not be behind and finish this up. This is just showing you some errors, okay? Just so you understand how they affect the debits and the credits, okay? So as we move on here, we are going, the last bit of analyzing transactions is knowing ultimately these financial statements provide information to the end user so they can make decisions. There is something that we call horizontal analysis. Is basically looking at our net income from one period and comparing it to the various income statement items from a previous period. When two statements are being compared, the earlier statement is used as the base for computing the amount and percentage of change. So horizontal analysis is just comparing the amounts on a financial statement with those from an earlier statement. Here you see the attorney and you see the income statement. You see years 2026 and 2027. 2026 is your base year. You use that to see increases or decreases, how a company is performing compared to the base period, okay? That's the biggest thing you want to know. I gave you your problems here. Was anyone in here that did not get the answers to these trial balances? Here's for problem 1. Here's for problem 3, 4, and for problem 2. I think problem 5, some of you guys got that earlier in the period. So you can buddy up with someone else. One sec. Are there any other questions that you guys can think of? Yes. Homework for this week are problems 1, 2, 3, 4, and 5. And they're in there. How did you guys feel like you did on the quiz? Did you have enough time to complete the quiz? Good. Time should never be an issue for you. If someone says, I need more time, I'll give everyone more time. That's not I'm not into, take your time, be able to relax and do your homework and quiz. How did it go last week? Did everything make sense? Were you able to get in the discussion and answer questions and ask questions? Stuart's really good, guys. How many of you reached out to him at all? If you need him, use him. Guys, he's awesome. I want him to be a teacher. He just doesn't want to get a master's degree. I'm here to help you, okay? I always like you to know what's going on in my world. I leave on an airplane for about 3 to 4 hours tomorrow. I won't have internet because Sun Country doesn't have internet, and I come home on Sunday night, 3 to 4 hours. So if you text me, you're not going to hear from me. Got it? How is everyone doing? Are you good? Yes.
I was going to ask, where do you journalize like sales tax for like a retail company?
We're dealing with that later. Basically, sales tax from a retail company would show when you collect the money, it's going to be right away. It'll be in your cash and it will go to sales tax payable. Okay. You know what I mean? Because it goes right away to your state.
Yeah.
Okay? Anybody else? Questions? How are you doing? But do you know what to do if you need help? Good. Take care, guys. Nice seeing you guys. Thank you. I'm going to have a great time. My daughter has a brain tumor, so she wasn't supposed to live for 9 years. So every moment I have with her, I'm glad to have it. Yes, dear.
Hi, I saw that attendees today that I had a 0.
Yeah, because you came in after I called it.
Okay.
So yeah, you just want to come in on time. But you're THUY?
Yeah, that's you.
THU. I'll put you in.
Okay, thank you so much.
You bet.
Question real quick.
Yes, dear.
So I just wanted to make sure. I think I sent you. An
I'm
email.
going there. Lake Tahoe.
Really?
Yes, that's where I'm going.
Sweet. No, I was just curious because it was like
No, that's cool.
kind of late Monday, so not that I really expected you to respond, but I just want to make sure I sent it to the right person.
Okay, what is your name, dear?
Benjamin.
St. Ives.
Yes.
Your flashlight's off.
Hey Siri, thank you. Hey Siri, turn off my flashlight. Benjamin.
Just say it might pop up. I mean, shows my email on here is
Benjamin. Hi, this is Ben. Sorry to bother you this late. Just a little confusing. Not sure why this isn't fees earned like the other ones. If you can get, okay, let me see. I'm so sorry.
Let's say no. I had a couple of questions on the homework, but
Fees earned. It
it
was a revenue. Fees earned was a revenue.
Right.
Remember, expenses will say the word expense after it.
Okay.
Does that make sense?
Yeah. Let's say I just wanted to make sure I got that to the right person. Didn't email.
It
some
was
random
me.
person.
I'm sorry.
No.
I try to be good. Yes.
It's all
Just
good.
sure that you it might be a little off or it might not show up a few classes in the future. I'll email you and let you know if
Thank you.
happens, just 'cause my daughter's passing,
I'm
so
sorry. I just
pretty
had
much let you-
my father-in-law just died last April, and so I truly get it. I mean, it's tough, and you never know what's going to happen. So thank you for telling me and let me know, and then I will always post both lectures, like the lecture from the other class that I do beforehand, and then this one. Always feel free. Thank you so much. Yes. Hi.
So I was looking at my military schedule, and I will be out of town for 17 to 20. I think I'll still be able to do the homework in time.
Okay,
and
but
get it
here's what I'm going to do for you. Email me, and then I can go into Cengage, and I will just automatically extend it for you. And if you get it in on time, fine. But I'm going to extend it. I will do anything for you.
in. It's just sometimes where we go, we don't have.
Honey, I get it. I had someone text me on this class because I always am. I said military, I'll do. Pregnant people, I'll do. She worked at the state fair for 11 hours a day for 8 days, and I just can't get it done. I said no. So I'm pretty hard about that, except for you and pregnant people. Or if you're in the hospital, of course I'm gonna. But military, absolutely. Just what I want you to do when you email me, say, just like give yourself 2 weeks to get it in. Like say, please extend it to this date due to military.
Okay.
And then I just do, and if you get it in on time, great. So,
Yeah, it's just sometimes it's hard to get.
honey, I get it. Don't worry at all.
Okay.
Take care.
Thank you.
You bet.
difficult to find them. I found the glue gun.
Oh, good, good.
Yeah.
And then that backing does adhere on. You know what I mean? The felt.
Yeah.
The felt does fit.
Okay.
You know what I'm saying? Up to the mirror.
Yeah. Yeah. I don't know how I got it in there. But
I'm excited. I'm gonna love it.
yeah. Yeah, she will. It will be really cool.
Is Jim around?
Yeah, he's here.
Tell him I'm gonna call him because I need to find out what he's gonna do tomorrow, if he wants to drive or not. So, okay,
He said he'll drive.
but tell him instead of going to the office around 9 or 10 in the morning.
Oh yeah, then we're gonna work in the office. Good.
Well, I'm going to hang out and then I'll be home. I'll call you on my way home. Okay?
Okay.
Tomorrow.
Bye.
Bye, Nate.
Cloud infrastructure. You've seen the headlines.
Okay, I turned flashlight off.
I did take a lot of, I was on this like anti-immunity drug, or immunity drug. I'm taking 2 huge honkers of that, just to make me feel. No, it's just great. I have really enjoyed this flight.
Yeah, we only got a couple more that we can do before we start moving back up.
I know.
What do we need for our over today? Pick me up.
You pick it, honey.
The only thing we can do in our life was make sure
Never. Okay, what should I do today? I need something fun before fall.
One last hurrah. So we just wait on the girls too.
Yeah,
I couldn't remember.
I always like to do the same.
Yeah.
I'm kind of weird.
That's not weird at all.
I don't know what to do. Should I do white one more time?
One more.
Okay, one more. I'll do white one more time. How was it?
It was good. I am kind of ready to stop entertaining people. All of Roger's
Oh my
and
gosh.
Brother Chad's family.